Hello class, this is chapter 4, Adjustments for Adjusted Gross Income. Learning objective 1, Student Loan Interest. When deducting interest for our adjusted gross income, we're going to have a limit on the amount we're going to be able to deduct of $2,500 per year. And an important distinction here is that the interest must be on a loan that's used for a qualified student loan, so qualified student educational expenses. Now those are essentially going to be the cost of attendance. So we're going to be looking at tuition, fees, books, supplies, equipment, room, board, those type of expenses. If the money is used for other purposes, then it's not going to be a qualified education expense, and it's not going to be a qualified loan used solely to pay for those expenses. So the interest would not be deductible in that circumstance. Now, there's a timing element as well, to where the qualifying education expenses must be incurred with a reasonable time. So this is going to be 90 days before or 90 days after the term in which the expenses are incurred, and that the student also needs to be enrolled half-time. So although the course study can be at the graduate or undergraduate level, just as an example, for an undergraduate student that must carry 12 hours for full-time status, they would need to be enrolled in 6 hours to make that half the normal full-time load. Additionally, the ability to take this deduction is going to do what's called phasing out based on the modified AGI, excuse me. So for student loan deduction, it's going to have a reduction when the modified adjusted gross income for a single individual, 70,000 is when that's going to start, up to 85,000 when it's going to be fully phased out. For married joint return, 140,000 is going to be when the phase out begins. And even though the slide says 180,000, it's actually 170,000 is when that ability to take the deduction is going to be fully phased out. Let's take a look at the calculation to determine the phase out. We're going to take the preliminary deduction multiplied by the fraction, and that's going to give us the amount that's disallowed. So for example, we'd take our modified AGI. If it was 140,000 at the lower end of the joint return, we'd have $0 once we subtract 140,000 from it. So we'd have a fraction of 0%. So we have no disallowed interest. If we had 170,000, the top end of that modified AGI, we would take 170,000 minus 140,000 to give us 30, divided by the 30,000 in our fraction. So we'd have 100% of that preliminary deduction, that 2,500 being disallowed. And then we're going to have a spectrum between those two numbers, and it's going to be similarly followed for a single taxpayer, with 85,000 being fully disallowed and 70,000 being 0% of the 2,500 disallowed. This is the student loan interest worksheet in which we'll work through it. We would not be submitting this with our 1040. It's going to be for our records, but will help us in that calculation for what we do submit on the Form 1040. Let's take a look at our learning objective 1. In order for the interest on a student loan to qualify for the deduction, the student must be enrolled at least, and that's going to be half-time. So for 12 hours for full-time, that's going to be 6 hours. Concept check 2. Under the student loan program, qualified education expenses include tuition and fees would be an example for a qualified education expense. Concept check 3. The deductible amount of student loan interest is reduced when the modified AGI for those filing married jointly reaches 140,000, and is completely phased out once it reaches 170,000. But the answer for the concept check is 140,000. Learning objective 2, health savings account deduction. Now, a health savings account, or HSA, is going to be a tax-exempt savings account. So it's money that you put in prior to your taxes being withheld. And it's got a purpose for it, to where it's going to be used for medical expenses. Now, not everyone can open one of these HSAs. And if the money is used incorrectly, as you'll see in a future slide, you're going to essentially get the money to be completely tax-exempt. It's going to be prior to taxes being taken out on the front end, which in some circumstances will defer those taxes, which is still a good thing. It's still tax beneficial. However, if we're using it for those medical expenses, it's going to be tax-free on the withdrawal as well. So there's going to be unable to exempt the entire amount of those funds from the taxes, which is certainly beneficial for the tax filer. Again, not everybody can be eligible for one of these HSAs. In order to be eligible, you either need to be self-employed, so this is going to be your method of creating money in reserve for medical issues that may come up in the future, or you have to be in what's known as a high deductible health plan. And we'll take a look at kind of the rules and limits are on those. But you need an employer to offer one of those. And then the employee needs to select, and the tax filer needs to select into that plan, or the employer not offer health coverage, and then the employee go out and purchase a high deductible policy on their own. Now again, there's limitations on what a high deductible health plan can be. It's going to have a specific minimum deduction and out-of-pocket limitations. Specifically for individual coverage, the minimum amount that the individual would have for deductible is going to be $1,350. So that means they at least need to be on the hook for that much. If the insurance is going to be more beneficial and pay more than that, then it's not going to be considered a high deductible health plan. And the maximum deductible is going to be $6,750. For family coverage, that's going to rise to $2,700 for the amount that the family needs to be on the hook for as a deductible. Otherwise, it's not a high deductible plan, and the maximum deductible here is $1,350. Now, there's also going to be a limit to the amount that the tax filer is able to contribute. Again, this is going to be a tax beneficial contribution, and if used for the medical expenses, tax beneficial for the withdrawal as well. So it's going to have a limitation on the amount that this can be done. Specifically, it's going to be a maximum contribution for an individual coverage of $3,500 and a maximum contribution for family coverage of $7,000. Now, the taxpayers who contribute are going to use the Form 8889 for either the contribution or the withdrawal. And as mentioned earlier, the contribution made is going to be a 4 AGI deduction. So assuming that the limitations are met, it's going to be prior to any taxes taken out. And then the distributions, which is the key to the HSA, are going to be tax-free as well, as long as they're used to pay for those qualified medical expenses. So this is going to be extremely beneficial for that tax filer. And then any insurance company or bank can be the HSA trustee. So this is going to be the individual that's going to be overseeing or being the custodian, essentially, of those monies. So let's take a look at the concept check here. To be eligible to fund an HSA, a taxpayer must be blank or an employee of an employer who maintains a high deductible health plan, or employee of a company that has no coverage, and again the employee goes out and purchases the high deductible policy on their own. So that's going to be self-employed. So self-employed can fund one of these HSAs, or employer offers a high deductible plan, employee selects, or employer offers no plan, and employee goes out and purchases a high deductible plan on their own. So concept check 2. If they're used to pay for qualified medical expenses, distributions from HSAs are, and this is the key here, those are also going to be tax-free. So let's take a look at the concept check here. If a taxpayer makes contributions to or withdrawals from an HSA during the year, they must complete a form blank and attach it to their form blank. So it's going to be the form 8889 that is either going to be the contributions or withdrawals, and that's going to be where that is completed. And then it's attached to the Form 1040, which is filed for the tax filing. Learning objective 3, military moving expenses. What we're going to look at here is going to be a moving expense deduction permitted by the tax filer for unreimbursed moving expenses ancillary to one of 3 types of military moves. It's going to be either the initial move, or what the military referred to as a PCS, or permanent change of station, from the home of the tax filer to wherever the military puts them first. So if you were born and raised in West Virginia like I was, and then received a first post of active duty in South Carolina, the military will assist in moving you from that home to the first post of active duty. The second situation that we're talking about is move from one permanent post of duty to another. In my specific circumstances, that might be the move from Shaw Air Force Base, South Carolina, to Scott Air Force Base, Illinois. And then the third and last situation we're talking about is a move from the last post of duty. And in my situation, that could have been from Scott Air Force Base back to West Virginia, or a nearer point, and in this case, the greater St. Louis, St. Charles area. And what we're specifically talking about here with the tax filer and getting this deduction is that it's not the expenses incurred, because those can be compensated for and reimbursed by the government, but it's the unreimbursed moving expenses that are incurred by the tax filer that you get that deduction for. Now, you're also not going to include in income the value of moving and storage that's provided by the government. So if the government goes out and pays the moving truck to move the goods, that's not going to be income, and it's not going to be a deduction. Similarly, for including an income, you're not going to, if you receive temporary lodging, or if they pay for a hotel while you don't have either on-base housing or you don't have a place to live during the move, that's not going to be included in income either. It's also not going to be a deduction for those expenses. So, and generally, if something is incurred above and beyond the value of those moving expenses, then you're going to have to include that in income. So you cannot profit from the move without paying taxes on it. And it's going to occur in one of two places. Either it should show up on your W-2 as additional monies paid above those expenses. However, if the government makes a mistake and they don't include it on the W-2 as a tax filer, you still need to include that on your Schedule 1. Now, travel also and storage is going to be types of expenses that we're going to be looking at here. And after the move, you're going to get the next month, essentially, consecutive 30 days for storage of the household goods, and then also mileage for travel. And that's going to be 20 cents a mile for the 2019 year was what the rate was listed at. Actual expenses also could be compensated. Now, the important thing here is you're going to have to pick one. You don't get both of them. So it's either going to have to be your actual out-of-pocket expenses for things like gas, oil, or else you just take the standard rate. You take the mileage that you traveled, and you get 20 cents per mile, and that's going to be all-inclusive in gasoline that you needed along the way, oil that you might have needed along the way. You're also going to be able to include lodging, but not meals. So you can't pay for, you can't get a deduction for food expenses that were incurred, but you can for lodging as long as it's unreimbursed. And then you can do expenses of parking fees and tolls, but not if you get off the beaten path. So if you go sightseeing on your move trip, those additional expenses, those additional lodging, are not going to be included in that deduction. And then a foreign move, you're going to get a little bit extra of something that's going to be considered a reasonable moving expense. And a foreign move is not going to be a move from a foreign country to the United States, but rather is going to be one of two situations. Either a move from the United States to a foreign country, or from one of those foreign countries to another foreign country. And foreign here is taken from the perspective of the IRS. So the IRS being an agency within the United States, it's going to be a country other than the United States. And then what you're going to be entitled to as far as one of these expenses is either going to be putting into storage household goods, and the amount of time is going to be for the duration of that duty station. So example here is if someone were stationed in North Carolina and then had received a foreign stationing in Germany, for example, and then were able to come back from Germany to North Carolina or Florida. The initial move from North Carolina to Germany would be considered a foreign move. The move from Germany to either North Carolina or Florida would not be. And then while you were moving from North Carolina to Germany, you would be able to move household goods into storage. You'd also be able to get the storage for all or part of the time that you were away from those items. And part of the thinking behind this is if you're moving to, say, base housing in Germany, that may come with furnishings. So you may not want to take your tables and chairs to Germany, put them in storage in Germany, and then take them back to North Carolina or Florida. It makes a lot more sense just to store them prior to your move to Germany and retrieve them upon your return. Let's take a look at the first concept check here. A service member who incurs moving expenses as a result of a move related to a permanent change of station may deduct any unreimbursed moving expenses subject to prescribed limitations. That is going to be true. Concept check 2, a spouse or dependent of an active duty military member may deduct moving expenses as a result of a military order and incident to a permanent change of station. That is going to be true as well. Learning objective 4, deduction for half of self-employment tax. Now, in a conventional employer-employee relationship, the employer is going to make a payment of 15.3% of what an employee is earning. They're going to do this as 6.2%, 12.4% total for Social Security, and then 2.9% for Medicare and Medicaid. Each of those amounts are going to be partly the FICA tax, so 6.2% that the employer is paying, and then 6.2% that the employer is withholding from the employee and making payment on behalf of the employee with respect to the Medicare and Medicaid. 2.9% is the total amount paid, but 1.45% being paid by the employer, and 1.45% being paid by the employer but on behalf of the employee. And in the self-employment situation, what we're going to be looking at is the fact that the individual is going to be paying both parts of this, both arms of this. So they're going to be kind of stepping into the shoes of what we would think of as what the employer would be doing in terms of garnishing payment. Here, we're going to look at it based off net earnings as opposed to the employee's contract salary. Those net earnings are going to be determined by the business revenues minus those business expenses, and then the self-employed individual will be taking 15.3% total off of that amount. So it's going to be as if they are paying the 7.65% from the employer perspective, and then the 7.65% of stepping into the employer's shoes and collecting from the employee and paying on behalf of the employee. So the way they get the deduction for this is the half that they are paying for on behalf of what we think of as in the employer-employee relationship with the employer, is you're going to get a 4 AGI deduction. That's going to be equal to half of that self-employment tax that's imposed. So the half that the employer would typically pay for the 6.2% for Social Security, and the 2.9%, the 1.45%, half of the 2.9% for Medicare and Medicaid, can be taken as a above the line, that is for AGI deduction for the 7.65%, just to get the same type of tax benefit that the employer's employer-employee situation is going to yield as well. Let's take a look at the concept check here. Concept check 1, self-employment tax is calculated on the blank earnings of the business. That's going to be net earnings. Concept check 2, for W-2 employees, the FICA tax is calculated at a rate of blank of their gross earnings for 2019. And here that's going to be 7.65%. And again, that's going to be 7.65%. That's going to be the FICA tax. And then also there's that corresponding 7.65% for a total of 15.3% is the aggregate amount. Concept check 3, an employer is required by law to withhold the additional Medicare tax from wages it pays to individuals in excess of blank dollars in a calendar year. And here that's going to be $200,000, and then the amount of that additional Medicare tax is going to be 0.9%. So for individuals making below the threshold, it's going to be a 2.9% withholding. For individuals above that threshold, for not just on the not on the entirety of it, but on the excess, on the amount above here, the 200,000, it's actually going to be 3.8% is what's going to be withheld. So for the individuals that make above the threshold, again, from $0 to 200,000 would withhold a total, including the tax and the withholding, of 2.9%. For amounts above that threshold here, 200,000, 3.8% is what's going to get withheld. Learning objective 5, self-employed health insurance deduction. Now, self-employed individuals may also be entitled to a deduction of 100% of self-employed health insurance payments, and this is for a similar reason as what we saw before, that an employer-employee relationship, often employers will step in and provide this and allow some of it to be paid for by the employer before taxes are levied, so they get it as a business deduction. To kind of take advantage of the same type of situation or offer the same type of situation. Here, the self-employed individuals may be able to deduct up to that 100% for that self-employment, or excuse me, for the self-employed health insurance payments. It's going to be limited in a couple respects, though. First, the taxpayers cannot take a deduction for the amount in excess of net earnings. So if you pay more in insurance than what you actually earned, you wouldn't be able to take a business deduction for it. It's similar to the situation that we're looking at. And then the second limitation is going to be the availability of health insurance coverage. So if you're entitled to participate in a subsidized health plan of either your own employer, if you're self-employed in one respect, but you do have an employer, or if your spouse has an employer that offers a health insurance plan that you would be covered in as the spouse, the deduction is not going to be permitted there. And then the eligibility for the alternative coverage is going to be determined on a monthly basis. So if you, at the start of the calendar year, at the start of the tax year, did not have this eligibility, but 6 months into the year were able to it, you'd be eligible for the self-employed health insurance deduction for that first 6 months, but would not be eligible to take the deduction for the second 6 months. Let's take a look at the concept check here. Concept check 1, self-employed individuals are allowed to take a 4 AGI deduction up to 80% of the cost of their self-employed health insurance premiums. That is going to be false. They're entitled to take the deduction up to 100% of the cost of that self-employed health insurance premium. So that would be false for number 1. Concept check 2. One limitation on this deduction is the taxpayers cannot deduct the premium cost that exceeds gross earnings from self-employment tax. Excuse me, from gross earnings from self-employment. That is going to be false as well. That you cannot deduct the premium costs that exceed net earnings from self-employment. And our third concept check here, another limitation on this deduction is that eligible participants in a subsidized health plan offered by the employer of either the taxpayer or the taxpayer's spouse will prohibit the deduction, and that is true. Learning objective 6, penalty on early withdrawal of savings. Now, if a taxpayer withdraws funds early from something like a certificate of deposit, there's going to be an early withdrawal penalty, or at least there likely would be. The taxpayer is entitled to report the penalty as a 4 AGI deduction, and they'd report it on line 17 of the Schedule 1. The amount of the penalty is also going to be reported on the Form 1099 INT, which is issued by the financial institution. So the financial institution essentially is going to report this out to the IRS on this 1099, and the taxpayer would be able to report this on their own Schedule 1, and specifically on line 17. So let's take a look at the concept check for this. Concept check 1. The early withdrawal penalty is reported on Schedule 1 of Form 1040 as and it's an above the line deduction or a 4 AGI deduction. Concept check 2. The amount of the penalty is reported to the taxpayer by the financial institution on a form, and the form is a 1099 INT, Form 1099 interest. Learning objective 7, alimony paid. Now, later in these slides, we're going to talk about what alimony is and how it's different than other payments that might be incident to a divorce, and also the fact that a tax filer could deduct, if they were paying alimony, deduct those alimony payments on their Form 1040, and then if you're a receiver of those alimony payments, you would report the money received as income. Before going into those slides, it's important to note that there was a new tax law that came into effect as a result of the Tax Cuts and Jobs Act that beginning in 2019, any divorce or separation agreement that's finalized, that's executed after December 31st, 2018, or any divorce or separation agreement that's finalized or executed prior to that date, but then is subsequently modified after December 31st, 2018, is not going to be a part of what we're talking about. So in those cases, the payer of alimony would not be entitled to a deduction for the alimony payments, nor would the receiver of alimony be required to include that amount in gross income. But it's still important to know how this is treated because of a lot of these divorce agreements and divorce orders and separation agreements that have been finalized prior to 2018 that are still in effect. But it's important to know that tax law change and the results of it. So the first thing I want to do here is take a look at alimony and see how it's different than other types of payments that might be incident to a divorce. So when the spouses are getting divorced, there's going to be a look and see whether children are involved in the marriage. If so, who's going to get custody of the children, and if any payment is needed to support the best interest of those child. If that is occurring, that is not what we're talking about here. Another thing that's going to be incident to a divorce is going to be something called a property settlement, and that is going to be similar to where if one spouse has a red car, one spouse has a blue car, and the judge says, well, we're going to give the red car to one spouse and the blue car to the other spouse, or if perhaps there's $100,000 in cash with the couple, and that there's also a $100,000 piece of real estate or a house, and then deciding, well, who's going to get the house and who's going to get the cash. And that's not what we're talking about either. What alimony is going to be is to support one of the spouses. And it comes about, for example, to where if, as part of the marriage, one of the spouses gave up opportunities to further their education or further their career, and then became dependent on the working spouse, or the spouse that was the higher income earner, or the working more time. Now, because of the divorce, they're kind of put at lesser footing coming out. So a judge may order that the spouse that was the one that had more economic means during the marriage to still contribute something to the spouse that had less economic means during the marriage because of that dependency, because they need that support. So that's what we're talking about here in terms of those alimony payments. And prior to that change, this would be a 4 AGI deduction, or an above-the-line deduction. So it would be prior to determining the adjusted gross income for the payer, and be included in income for the receiver of alimony. Now, in order to qualify as alimony, it's got to be cash. It's got to be required under the provisions of this divorce decree, the divorce order, or a separate maintenance agreement, and that all payments must end when the payee's spouse's death. So you can't transfer the payments on for another individual. So the alimony payments are going to decrease sharply in the second or third year. Then it's going to be subject to recapture. And what that is going to be is if they are trying through the divorce court to conduct property settlement as in the form of alimony. And the tax law is going to say that does not count. We're looking at substance over form. So even though you may call this alimony, you may have a judge sign off on it being alimony. If you do something along the lines of, say, we're going to pay you alimony of $100,000 in the first year, and then $1,000 for each subsequent year, the $99,000 that you pay of the $100,000 in the first year is going to be considered the same thing as a property settlement. It's going to be the same thing as just splitting cash up. So that's going to be how those rules are effectively going to reclassify that payment for tax purposes to say it's not going to be considered alimony, but in fact is really going to be property settlement that's just being disguised as this alimony payment. So let's take a look at our concept check. Concept check 1. Alimony may be paid in either cash or property as long as the payments are made on a regular basis to non-live in-ex spouse. That's going to be false. Concept check 2. For payments to qualify as alimony, the couple must be legally divorced at the time the payments are made, and that is also going to be false. Concept check 3. The goal of alimony recapture rules is to properly define the substance of payments made to a former spouse to ensure proper tax treatment, and that is going to be true. Learning objective 8, educator expenses. Now, educators are going to be eligible to deduct up to $250 of qualified education expenses as a 4 AGI deduction, or an above-the-line deduction. If you are married and filing jointly, then the total maximum deduction is going to be $500, but there's a catch here to where neither spouse can deduct more than $250 of his or her expenses. So if one spouse has $300 in expenses, one spouse has $200 in expenses that otherwise would ordinarily qualify, even though you're at that maximum deduction of $500, you could only take the $250 plus $200, or $450 for that deduction. And the qualifications are going to be also included here, and it's going to have the effect essentially of making the teachers need to be full-time teachers. So the qualification under 900 hours is going to be measured within the academic year. So if someone only teaches for 800 hours during that period of time, then they may not be entitled to this deduction. But it's also important to note that even though that qualification test is measured within the academic year, that being fall to spring, that the deduction itself for the expenses is measured in terms of the calendar year. So spring first and then fall, which also lines up with our tax year. And for what that $250 was spent on, it's got to be a qualified education expense, and that's going to be books, supplies, equipment. This can include computers and software, and then the expenses must also be ordinary, so common and accepted in the education field, as well as necessary, so that's helpful and appropriate. So you need those expenses to be both ordinary and necessary. So let's take a look at our concept check here. To be eligible for the deduction, an educator must work at least blank hours in the job. And that's 900 hours. So if you're a full-time educator, you're likely to achieve that 900 hours. However, if you're, say, a substitute teacher, then you may not get to that amount. And if you do not get to that amount, then you're not going to be eligible for that $250 deduction. So concept check 2, the maximum deduction for a couple who are both eligible educators and both filing as the married filing jointly is going to be, and here it's going to be $500, but keep in mind that there's going to be still $250 for each individual. Concept check 3, expenses for blank and blank do not qualify for this deduction. Here's going to be homeschooling and non-athletic supplies for health or PE classes.